Welcome back to Squawk Box. We got some big news, and CNBC's Huson reporting that Wells Fargo will significantly step back from the housing market. This is a big-time shift for what was once the #1 player in mortgages. Huson is here this morning with that news. Kind of a blockbuster here in terms of the mortgage market and what Wells has been doing for decades.
I think so, Andrew. Hey, good to be with you. Good morning. So if you look back at the financial crisis, as you know, caused by shoddy, underwriting with mortgages, they would give a mortgage to anybody who could fog a mirror. What you saw was that Bank of America, which had bought Countrywide, which was the biggest mortgage lender in the country, and Jamie Dimon's JP Morgan both receded from the market. They said, you know what, too many risks here. We've been burnt too much, and this brings too much heat from regulators. And Wells Fargo, interest rates were low, and this was really their crown jewel, the mortgage business, and they stuck around. And in 2012, 1 out of every 3 mortgages in the country were underwritten by Wells Fargo, all the way through 2019, when they still had a #1 mortgage market share. And for those 5 or 6 years, honestly, Andrew, they looked like geniuses. They were printing money. They had the biggest market share in the business, and things were going great until, obviously, what happened with it. The fake sales account scandal, bringing tons of additional heat to them. That, on top of what you saw with interest rates in the past year, Charlie Scharf, the new CEO, saying, look, this is not a business where we need to be the biggest. We need to serve just primarily the customers who already have other existing relationships with us, checking accounts, wealth management, credit cards, and our dual mandate, the other mandate being the minority communities in which they are obligated to serve and serve better than they have historically.
In terms of the bottom line, is this going to help or hurt them long term, you think?
I think it's going to help. If you look at the Wells Fargo's major competitors among the mega banks, they both, JP Morgan, Bank of America, this is not a priority for them. They serve their customers as a part of the full spectrum of other products they have. And in that context, it can be profitable. Now, if you're in a business where you're making money in the good times and you give it all up in the bad times, or it brings too much heat from the OCC, from the Fed, from the CFPB. You recall last month they had a $1.7 billion fine, Wells Fargo did. It's just not a great business to be in for the long term. If you look at their competitors, they enjoy higher valuations, better share prices. And as a result, I think you'll see Charlie Scharf, who you recall spent 25 years under the tutelage of Jamie Dimon, making Wells Fargo looking a lot more like JP Morgan Chase, looking a lot more like Bank of America.